Wealth Building Secrets for Real Estate Investors presents 7 Deadly Investor Traps. The Wealth Building CPA. Aberi Okoye is a CPA, an active real estate investor, and founder of Wealth Building CPA. She owns real estate investments in 5 states across the Eastern Coast. Her company has helped over 5,000 people like you prepare their taxes online and offline. Her greatest joy comes from helping clients, friends, and associates become free of financial stress. Call her at 1-888-502-3767 or visit her online at www.wealthbuildingcpa.com or contact her via email at info@wealthbuildingcpa.com. The WBCPA Advantage. Being in the industry for so many years, I am very familiar with money-saving strategies which I love to implement all of the time. Combined with my 18 years experience as a CPA/tax strategist and 11 years experience as a real estate investor and business owner. With this combination, it would be a great pleasure for me to empower you to make your financial life so much more profitable. What this means for you is that you can trust us as one of your team members so you can spend more time and money in your business. The Ultimate Wealth Building Plan. Stage 1 Focus, Financial Needs Analysis Questionnaire. Stage 2 Focus, Tax Planning and Preparation. Stage 3 Focus, Entity Structuring and Formation. Stage 4 Focus, Business Registration and Bookkeeping Setup. Stage 5 Focus, Business Analysis Meetings. Stage 6 Focus, Investment Property Purchasing. Stage 7 Focus, Retirement Planning. Stage 8 Focus, Year-End Tax Planning. For more information, please visit www.wealthbuildingcpa.com/theultimatewealthbuildingplan.html after this presentation. The Ultimate Wealth Building Plan. The Wealth Building Program is a 12-month training program that takes you step by step through the steps required to run a successful and efficient real estate business. Aberi and her team have developed this system after years of working with business owners and real estate investors on how to best use their professional skills, passion, and experience to pursue their entrepreneurial dreams. This program focuses on a specific element of the wealth building system: tax planning, tax preparation, entity structuring, business meetings, etc. At the end of the 12 months, you'll be in a position to operate a successful real estate business. During these 12 months, Aberi will work with you on all aspects of your finances that will reduce your chances of mistakes due to the chronic lack of communication and integration of services between your CPA, lawyer, tax, and investment advisor. Aberi also has a special component of the wealth building plan designed specifically for foreign and out-of-state investors. Stage 5 Focus. Business Analysis Meetings. Do you ever worry about getting high enough returns on investments, maintaining your standard of living at retirement, affording high-quality education for your children, the next market crash, the next market boom? What about missing out on the latest, greatest stock tip, making sense of all the information available, someone else having a better portfolio than you, not having money to care for your loved ones, getting bad advice, and, worse yet, paying for it? If you answered yes to any of these questions, you could be trapped in the investor's dilemma. Once you understand the phases of this cycle and what happens to your investments as a result, you will gain a whole new perspective on investing. The investor's dilemma is a vicious cycle that can stop your portfolio dead. 7 Deadly Investor Traps. 1. Fear of the future. 2. Forecasting the future. 3. Track record investing. 4. Information overload. 5. Emotion-based decisions. 6. Breaking the rules. 7. Performance losses. Why your broker is hurting you. Brokers and financial planners are incentivized to sell products, not give clients peace of mind. They don't want to build diversified portfolios or help the investor understand their investments. They are gambling with your money, not thinking long-term. This devious, dishonest way to manage people's money is a dirty little secret in the industry. They think they can beat the market and predict what will happen. The question is, should you actively manage money by speculating or invest money in a broad cross-section to eliminate additional trading involved in forecasting? In a free market, only unknowables will affect the price going forward. Brokers' performance is more luck than skill. They are full of broken promises for untold riches. They are gambling with your money and speculating your financial wealth that you need for retirement and your family's future. Unfortunately, many confuse gambling with prudent investing. 3 key warning signs you are gambling. 1. Trying to pick the best stocks when the average turnover on a mutual fund is 100% every year. 2. Timing. Trying to predict and forecast when to get in and when to get out. This is very dangerous. 3. Track record investing. Going with a broker or manager who has a stellar past performance and hoping they can repeat it. How to invest wisely. Own a cross-section of assets to achieve a better rate of return. There is no stock picking required, no gambling, and you own every stock in that category. Diversify your asset categories with dissimilar price movement. When one crashed, the other stays up. 7 deadly investor traps. 1. Fear of the future. The cycle begins with a sense of uncertainty about the future. The list goes on, but the common quality is that almost all investors are afraid that either they don't know enough or haven't saved enough, and, as a result, will find themselves destitute and powerless in the future. You might not even be fully aware of the impact these fears have on your life, because it lurks under the surface in your subconscious. Fear plays a large role in dictating how investors feel as well as how they behave. 2. Forecasting the future. Many investors feel the need to get some kind of prediction about what's going to happen in the future. After all, if someone could just tell us what is going to happen with inflation, long-term interest rates, share prices, overseas markets, etc., then there would be nothing to fear. It would be so much easier if someone really had the answers. It is easy to lose sight of the simple fact that it is just not possible to predict the future. 3. Track record investing. If you did need a prediction about the future, what would be the most logical place to look for it? History? Experience? In other words, the past. In investing, looking to the past to get an idea of what investments or managers will do well in the future is called track record investing. For example, looking for managers or funds that have recently outperformed the market, hoping that those same managers will continue to do the same in the future. 4. Information overload. Information today is so readily accessible that most investors get more information than necessary without even trying. Investors remain stuck in a scarcity mentality, frantically acting on a need to seek more, better, or different information, regardless of its usefulness. Instead of reducing fears and doubts about investment decisions, this deluge of information only intensifies investors' anxiety. They are on overload. 5. Emotion-based decisions. You can never overcome your own humanity. As much as we would prefer to think that we make investment decisions based purely upon logic, advertisers and journalists are well aware that emotion ultimately drives most investment decisions. It's easy to overweight information that validates our perspective while minimizing any information that goes against what we inherently believe. 6. Breaking the rules. The commonly held rules of investing are 1. Own equities. 2. Diversify. 3. Rebalance. And the golden rule of investing is buy when prices are low and sell when prices are high. All of these rules sound simple enough, but when people make investing decisions about the future based on track record or emotions without realizing it, they wind up breaking these rules, thereby sabotaging their portfolio. 7. Performance losses. Put all the phases of the investor's dilemma together, and what you get are performance losses. Simply stated, investors fail to capture the kind of returns they expect. Typically, they expect to get the returns they see listed in the newspaper, online, or in magazines. However, it is rare that the average investor actually achieves the same returns as published in the newspaper. These kinds of losses can't help but create additional frustration and fear about the future, thereby initiating the investor's dilemma cycle all over again. The results? Not enough money and no peace of mind. In the end, the result of the investor's dilemma is people who don't have enough money to accomplish their most meaningful life goals and dreams. Not only are they not where they want to be financially, but they have also spent a large portion of their lives fraught with stress, anxiety, concern, and fear that initiate and perpetuate the dilemma. Ending the investor's dilemma. Don't focus on returns and track records. Do focus on maintaining long-term discipline. Don't use actively managed funds. Do use structured or index-type funds. Don't use a commission-based broker or planner. Do find an investor coach who will work with you. Don't rely on the media for advice regarding your investments. Do find an investment strategy that fits you and stick with it. Don't let your emotions dictate how you manage your investments. Do let your investment strategy do its job. 3 simple strategies for investing success. Eliminate speculating and gambling in your portfolio. Use market forces. Don't fight them. Fire your broker and hire a coach. Eliminate speculating and gambling in your portfolio. Anytime you pay a fee or a commission to active managers to pick stocks that they believe will beat the market, you are, in effect, gambling that those stocks are the winners and that others are the losers. The first power strategy is to stop this self-destructive behavior once and for all. In life, it is often just as important to stop doing the wrong things as it is to start doing the right ones. Use market forces. Don't fight them. Don't fight market forces by attempting to beat the market, because the vast majority of hyperactive managers fail to achieve market returns. By focusing on market returns, there is no stock picking at all, no forecast, no prediction. You only need to allocate your assets into various categories to achieve market returns. This is easier said than done and requires the aid of a knowledgeable coach. Hire a coach. Just as you would hire a coach to improve your golf swing or your tennis game, an investing coach can help you maximize the benefits from your investment strategy. A coach can help you make the prudent decisions about how much volatility and what types of risk you want to incorporate into your portfolio. A good coach also aids you to truly understand and measure diversification in your portfolio and works with you on what you really want your money to do in the future. You will get peace of mind. Your next step. Knowledge without action is useless. Your next best step is to contact a Barry Okoye CPA and schedule a meeting to begin answering these questions today. Don't put it off. It is too important. You owe it to yourself and your loved ones to find out the answers to these questions. Your coach has been trained and educated in the art and science of walking you through the process to resolve these problems. Coaching is the solution. Call a Barry today to schedule your investor inventory. You can reach a Barry Okoye at 1-888-502-3767 or online at www.wealthbuildingcpa.com or via email at info@wealthbuildingcpa.com.